Hey everyone, thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM. And my email address rshaw@fxcm.com. Today is Tuesday, the 28th of June. Just going to bring up our high-risk investment morning. I'm going to keep this on screen for a few moments. Just regarding Friday and yesterday, I've been working on our Q3 report. It's now done. I finished it yesterday. I sent it through to our compliance. There's just one or two corrections that I want me to make on the I think with one link and some parts in the disclaimer. But besides that, it's done. So I just wanted to give you a sort of a reason for missing Friday and this morning, but that's going to be available soon. Hey Howard, okay, yeah. So the reason you didn't get for yesterday is I'd cancelled. So apologies for that. All right, let's. Here's our market commentaries disclaimer. Going to keep this on screen. Hey, Zanetta, morning to you. Nice to have you on the webinar. Thank you everyone for joining this morning. I appreciate it. And here's our references: Market Scope, CNBC.com, TradingView. We'll start off with CNBC. Then we'll just consider this US 10-year, and then we'll do some analysis on the DAX, see if we can pick up any opportunities. All right, so the CNBC European markets article reads as follows: European markets head for negative open as global investor confidence dips. European stocks are expected to open in negative territory on Tuesday as global investor confidence sees another dip. The lower open expected in Europe comes against a backdrop of trade elsewhere. Shares in the Asia Pacific region were mixed on Tuesday as the investors weigh economic concerns. US stock futures were little changed earlier on Tuesday following losses in their previous session. Investors stateside will be looking closely at more data later today, including June consumer confidence and April home prices, to gauge the health of the economy. Fears of a recession have increased lately as the Federal Reserve tries to combat surging inflation with aggressive rate hikes. In other news, the Group of Seven summit in Germany will conclude today. The meeting of leaders from the world's 7 most wealthy industrialized nations saw the group reaffirm their support for Ukraine, saying they'll support the country for as long as it takes. In Spain on Tuesday, the latest NATO summit opens with the war in Ukraine top of the agenda. The Alliance's Secretary General Jens Stoltenberg said Monday that NATO will greatly increase its high readiness force, raising the number of troops from 40,000 to 300,000. There are no earnings in Europe on Tuesday. Data releases include the GfK German consumer confidence figures. All right. I want to just start off with taking a look at the US 10-year. I'm still of the opinion that this is key, that the yield environment, because it really would reflect just how aggressive the Fed is going to be. And the Fed, it can change, and if it changes from being extremely aggressive to less aggressive, or changes to being even more aggressive, that's going to be discounted into yields. So we want to just keep an eye on this. And what this is to me a potential continuation pattern. And I'll just put in what I think it may be, and it's sort of a flag, I would imagine, which is broken out. We say, all right, now these sort of flag might even be, you can just maybe make it a bit more like what we call a falling wedge. Maybe it's a falling wedge. I don't think it changes the outcome. So I just want to explain my reasoning here for looking at these continuation patterns. I think looking at continuation patterns is extremely important. My personal opinion is that they help hugely, because it's really comes down to the core of what we're trying to do in the webinars. And the cores are always trying to find the pullbacks. So the pullback leads typically into an impulse, the correct impulse, correction, impulse, correction. That's sort of to the upside, right? To the downside would be impulse, correction, impulse, correction. So again, I just just call this the heartbeat or the pulse of the market, because it's kind of, when you have a trend, it's never going to move in a straight line. It's always going to move in these waves, in these zigzags. And then just to make it a little easier in terms of identification, the impulses we've always would label 1, 2. This is not, don't get this confused with Elliott wave. That's not what I'm trying to do. 1, 2, then the pullbacks 2, 3. Once the pullback's finished, we have the next 1, 2, and then we have the next 2, 3. The 2, 3s are the corrections. The 1, 2s are the impulses. 1, 2, and we want to trade the 1, 2 swings. That's what swing trading is. And then the 2, 3s are basically the setups. And again, if you look at it on the downside, well, here the impulses must be to the, because it's down, it's a downtrend. The impulses would be in the favor of the trend. So 1, 2, then we would have 2, 3. Okay, then when we can identify the end of the 2, 3, we have the next 1, 2. Okay, and this is just our labeling. Got nothing to do with Elliott wave, which I think is a a fantasy. But so 1, 2, 2, 3, 1, 2, 2, 3, 1, 2. Good. All right. So now if we've got this pulse, if we've got this heartbeat, then the continuation patterns start making more sense, because these 2, 3s would typically be your classic patterns. So what would your continuation patterns be? So you would have kind of 1, 2, then sort of a 2, 3s, maybe a falling wedge, 1, 2. Maybe you'd have a flag, something like that. 1, 2, maybe a pennant, something like that. Yeah. You could also have sort of a rectangle, a small rectangle, or a small triangle, or whatever you want to call these things. But the point is, what we're really looking for here is just the rhythm, just that heartbeat. If we can kind of pick the heartbeat, and in trends there should be a beat, right? So that's kind of what we're trying to do here. So then this correction here, we want to watch, because if it's a continuation pattern, well then we are perhaps going to see higher rates, and that wouldn't surprise me. So 1, 2, okay, 2, 3. Let me just try. My system is slow as can be. All right, what's happening here? 1, 2, 2, 3. Okay. 1, 2, and then we'll get the next 3. And what typically happens here is that the 2, 3s are always going to be accompanied with commentary, media commentary, and that's where it becomes difficult, because is the commentary, has it got a basis? Is it sensical, or is it just a narrative to fit the market move. So the idea, well, perhaps the Fed cannot be as aggressive. Perhaps the Fed cannot be as aggressive. That, by the way, could be correct. Could be correct. But of course, if they are still going to be aggressive, then maybe this is just the pulse, a heartbeat. I don't think that there is any real. I don't think there's any real evidence of a slowdown in rates. And again, the rate increases are not really the issue, in my opinion. The issue is the normalization of the balance sheet. We've spoken about that, and that adjusts via a price mechanism, and interest is the price mechanism of money. Okay, so we still need to watch this like a hawk, because if it continues to move up, it is going to have a bearing on our trades, and we are traders, we're market participants. So this becomes exceptionally important for us to keep an eye on. So we want to watch this. Another interesting, I guess, direction we can take the US 10-year, and I think that I have mentioned it in the Q3 report, is to actually look at it in terms of real rates. Now let's just understand what I mean by real rates, because again, it's going to have a huge bearing. It's going to have a huge bearing on financial instruments, whether we want to short them or trade them or long them. I think the understanding the underlying fundamentals is very helpful. So what we're looking at here is a 10-year. Sorry, I'm going to cough. I'm just going to mute for a moment. I beg your pardon. All right, I'm just going to, so I'll go to labels here. I'm just going to bring up last. So you can see we're trading at about 3.2%. Okay, now that 3.2% is actually what we call a nominal yield. So it's not a real interest rate, it's a nominal interest rate. Now, let's just show how we get that. So a nominal interest, we go nominal. Let me type that again. I'm begging your pardon. My system really is not responding as sensitively as I'd like. Nominal rate, which is the 3.2, okay, equals, now watch this, very important, real rate equal, plus inflation adjustment. Okay, that's what we see here. So we're seeing components, two components reflected in this 3.2. We're seeing what we call a real rate, and we're seeing an inflation adjustment. And basically, what happens is if we are in a high inflationary period, which we are, that would obviously make up a larger component of the nominal rate. So if we get a real rate that's positive, something miraculous actually starts happening. Okay, because if we rearrange as follows, if we go real rate equals, so what would the real rate be? It would be your nominal minus inflation adjustment. In other words, if you get a positive real rate, that's a real return. That means you're getting a return after inflation. Okay, so that in a high inflationary environment, if you're getting an interest rate that is beating inflation, that's very compelling. So what we can do there is we can go like this: US 10-year, okay, minus, okay, and then what you have here is called a break even. So it's in here a 10-year break even rate, okay, and that's effectively making an adjustment, okay, for inflation. You're just taking your nominal, you're minusing your break even, and that's going to give you a real. It's going to give us our real, okay? And you can see, what do we have here? We've got it at a positive, it's above 0. So theoretically above 0, you're making a real rate. Now, this over here can be debated, by the way. We're looking at this purely in terms of financial instruments. We're not looking at it in terms of headline inflation, which is rampant. Okay, so we've got to make that distinction. Like, are we really earning a positive real rate? And the answer to that is probably no. Okay, the answer to that is probably no. But if you are a financial participant, a market participant, if you're a portfolio manager and you have to work with something, well, these are the instruments you're going to be working with. And ultimately, a portfolio manager's job is to actually manage risk. That's really what the portfolio manager is going to do. Everything else is secondary. Okay, so if they can manage risk, then a positive real return becomes hugely compelling. Okay, guess what we have here? Do I see that? So the market probably expecting some sort of increase in real rates, which is again an argument that we make in our Q3 report. So what does that mean? Well, let me show you one very interesting observation I made while I was preparing the Q3 report. So what we're going to do here is we are actually going to change this to a weekly. Okay, so we're going to lose the granularity of the continuation pattern. Okay, we'll lose the granularity there. And what we're going to do here is kind of a looking chart. Somehow the price doesn't look familiar. If it doesn't matter, I think we can make the. Because I've got logarithmic on that one. All right, beg your pardon. Okay, let's just add the gold chart underneath. Now watch this. This is hugely fascinating. Gold has been a safe haven for the longest period. It still is a safe haven. I mean, I wouldn't say it isn't, but it's certainly not performing as well as it did in the 70s when we had the other the previous supply shocks, the oil. Oil crises and oil crises too. If you add gold underneath, well, one of the reasons gold is possibly underperforming. Well, look, as we go positive with our real rate, that's really when gold takes its knock. Isn't that fascinating? Isn't that fascinating? So it's kind of here is the knock in gold, right? Here is where our real rate goes positive. Okay, and it's, I think something that so we got to watch yield. Let's add in one more piece of the puzzle before we go through to the DAX. We're considering the US dollar. Right, look at that, how it sort of jumps up when we go real. No. Okay. This we can actually make logarithmic. I think we should, just to get a fair view. And this we should make logarithmic to get a fair view. Okay. It doesn't really adjust all that much. The reason it doesn't adjust all that much because it's a short-term analysis. You need to use logarithmic on your long-term analyses. All right. So you can see. So this is really important for us because I am of the opinion, and I'm going to tag in my now favorite sort of phrase, subject to correction, that real rates are set to continue higher. And if real rates are set to continue higher, because think about it, what we're trying to do here, what the central banks are trying to do here, they're looking to tame inflation. They're looking to tame inflation and they're looking to raise rates. What if inflation gets tamed and if rates get raised, real rates theoretically need to go up. And if real rates theoretically need to go up, well, you can see what's happening to gold. You can see what's happening to the US dollar. We're going to carry this. We're going to carry this theme on, I think, for a fair period until we get sort of a clearer picture. But this is what I think is happening. If there's any questions, of course, just go ahead and you can go ahead and type those in. I want to do some analysis now. Let's go through to this chart here. Here's our DAX. Okay. This is the daily. Let's start off with the weekly here. All right. I'm going to get rid of this. I don't think we need this. Okay, so we want to look at this in terms of our peaks and troughs, because that is the definition of trend. We understand the underlying dynamics of the rates are moving. And why we want to keep an eye on rates is because as real rates increase, and I would suggest, although we've looked at the US, I would suggest this is I'm using that as a proxy for sort of global direction. It might not be as smooth from one region to the next, but I would expect real rates to be generally increasing on a worldwide basis, and that obviously affects let's put it this way, it affects the time value of money, let's apply that directly to the DAX via trend. And here we've got the lower peak, okay, and here is the lower trough. And the reason that I think we've got this lower peak, lower trough is precisely because the real rates are starting to appreciate. And what we can see here on the weekly is that the momentum has rolled over, and that's a bad sign for a market that's already been hammered. If we've been hammered and we haven't gone into our lower quintile, gee, that has very uncomfortable ramifications, doesn't it? So if we continue down towards the 20 area and we hold that area, then the DAX comes under more pressure. That would make sense if real rates are moving up, because it would put pressure on the present value of risky securities, and money will rotate towards instruments that are yielding a positive real rate. So there is a real potential for shift here. Now we go through to our daily chart. Again, let's get rid of this RSI. And what we can see here is that we're trying to get out of zone 3. Getting out of zone 3 certainly would be a positive step. Let's keep an eye on today's price action. I'm not quite prepared to say, that the market is moving from zone 3 into zone 2 on a sort of an underlying bullish momentum. What I would be worried about here is potential bear market rallies. If we go from zone 2 into zone 1, I think that would take a lot of the edge off. I think I'd be a lot more positive. But right now, I'm really nervous about bear market rallies, and you can see that we've got a bearish momentum here. Given the fact that we have a downtrend on the weekly, given the fact that we're still hovering zone 3, what I would be doing on the hourly is I'll still be looking at resistance areas to see if they provide any sort of key levels. So right off the bat, R3 comes up, but I think that R3 for our purposes might be a little too far. I'm just going to shift it down here to sort of maybe an R2. So I'll keep an eye on the R2, and what I'll be looking forward to see is if the R2 resistance holds. I don't want to forecast that, I want to preempt it. It either holds or it doesn't hold. If it powers through, it powers through. I'm on the wrong sort of side in terms of the analysis, but I haven't committed any cash. But if it holds, then what I would like to do is watch the trend following indicators. Are the trend following indicators suggesting that there's a rollover? Is the stochastic starting to turn, suggesting that the momentum is waning? Why wouldn't I want to catch the signal here? The signal here looks beautiful. We've got a bullish crossover on the moving averages, which is trigger 1, and we've got a terrific crossover on the stochastic, and the stochastic is making its way towards the upper quintile. That's bullish on the hourly chart. What I am worried about is that the hourly chart is beholden to the daily chart, and the daily chart is beholden to the weekly. In other words, I'm worried that these are 2-3 corrections. I'm looking to get involved in the 1-2 impulses. Okay. Now, if by some chance this actually turns out to be the lows, because we can say, well, what happens if this proves to be some sort of double bottom or something, which again is a possibility. Then we're going to have to re-look at the fundamentals. But let's just say this turns out to be some sort of, that's okay. That's okay. I'll need it to prove itself to me. In other words, okay, I'm picking the bottom here because I don't know if we're at the bottom. But if we kind of have something like this, let's just say the DAX does this and kind of moves up. Fine. Let's say it does that. Then I would need to see that. Now, so I'm late because I've missed out all of that. I have to be happy with that and confident that if this is a true turnaround, that the bullish trend will be long enough for me to capitalize on it. Again, let's end it off there. So something like there to there is kind of that's the areas we operate in. So that's effectively the analysis. There's no such thing as absolutes. I don't know if this is a bear market rally. I fear that it is. If it turns out we're at some sort of really true value buying area, that will prove itself to me. I don't see it. The momentum's rolled over. The zone is still looking fragile, and we still got this ton of resistance above us. I'm not quite comfortable to accept this type of bullish signal just yet. All right, I think that's where we will leave it for this morning. If there's any questions, please go ahead and type those in. Any questions, please go ahead and type those in. Tomorrow we will do the morning market review, and of course we will do Bitcoin in the Crypto Minute as well. So please join me for that. Thanks, Rob. Just I want to, so Rob has been sending me some emails. I really enjoy corresponding with you guys. So if anybody wants to send me an email, please, there's an open invitation. And yeah, Rob, again, open invitation. So if you want to carry on the the communication or the correspondence, that would be terrific. All right, guys, I'm going to wrap up here. Just before we do, you can already see this R1 perhaps starting to show an influence. So let's just keep an eye on that. Catch you guys tomorrow.